the name of our session today is Data and Analytics Innovations, Traditional versus Non-Traditional Data Underwriting. Now, before we get into the questions, I have to say it was kind of interesting in reading the agenda. The word innovation seems to have quite a role in this year's conference. But quite frankly, it's really got a big role in conferences and even boardrooms everywhere, right? Seems like everyone's talking about the pace of innovation and its impact on the businesses that we're all a part of. And from my perspective, innovation takes really many forms. I think the most obvious one that we all think about when we hear innovation is that of technological innovation. But really across the world, there's a whole bunch of different types of innovation going on. There's innovation in process. There's innovation in treatment regimens in the medical world. And then here in our industry, there's innovation in funding structures, technology, data types, and more. It's really all around us all day, every day. So today, what we want to talk about is how some of the innovations that we're seeing, specifically around data analytics, specifically around the use of traditional versus non-traditional data is impacting our business. So Joanne, we'd like to start with you, actually. And FICO, of course, has really a very long history of providing scores that have been used globally as part of the overall underwriting process. In fact, I think I read a stat that said something like 75% of all home loan originations are given based on FICO-related insights. So if you could, can you talk a little bit about how FICO views alternative data sources, sort of how its emergence has changed what people might know as the traditional FICO score, and maybe even in the beginning, just sort of help us define what we mean by alternative credit data.
Yeah, absolutely. Thanks so much, Mark. I'm pleased to be with all of you today. So when FICO thinks about alternative data here in the U.S., so let's think about that first before we talk about outside of the U.S. And our experience there. We say alternative data means data that resides out of the three main credit repositories. So we have, think about your traditional, credit line data is there. There might be public record data, inquiries, and there's a smattering of data that would be new coming into the repositories. Some rental data makes up less than 1% of what's at the credit repositories, as well as a little bit of utility and telco, both combined making up less than 4%. But we say once it's kind of made its way into the three credit repositories, we refer to that as traditional data. And I think CFPB is kind of using the same definition as FICO. So when we think about using alternative data, that means going and looking at data sources outside of the repositories that could be beneficial in terms of providing credit insight into the consumers that we would refer to as credit invisible. Within our experience, we'd say that there's roughly in the U.S. 25 million consumers who are credit invisible, meaning they have absolutely no record at the three credit repositories. They tend to be skewed to a younger population, a median age of 21 or new to country. We think this is a population that there are lenders who are credit hungry that want to approach finding a means to provide credit access to this population. And so we've spent a lot of time doing research specifically to understanding how we could go about finding alternative data that would be useful for both lenders as well as beneficial for consumers. There's also just another side, about 28 million consumers who happen to have some information at the credit repositories. We just happen not to score them because of our minimum scoring criterion, making certain you have at least a trade line open and a trade line open for a period of 6 months. So there's credit records out there that perhaps are only public record information and or something less than what we just talked about. So when we think about the guidance, we go through a step-by-step process as we evaluate alternative data sources. So I'd just like to mention that to you. So the first is regulatory compliance. So make certain that we're only using those data sets that are FCRA compliant. What does that mean? That they have to have the appropriate structure in place in order to handle consumer disputes. So it needs to be fair to the consumer. So that's the first and utmost for us, because our lenders expect FICO to deliver an FCRA compliant score. The depth of information, so how deep and how long a history is there of that data? We want to be able to understand that data stream over a period of time. So something that is less than a 2 year, it's been a long day, 2-year window is going to be insufficient for us to really do a good job of predicting future performance at that. So we're looking for depth of information. Then scope and consistency of coverage. So, obviously, something that represents a large national sample is going to be substantially more useful to us than something that is regional and has a very small amount of data available to it. An example there would be that we're using a telco data set for an alternative data score that we use, that has over 200 million records. That, absolutely meets our scope and consistency of coverage type of test. Accuracy. This is really important as people are talking about using social media and other types of data sets. We say it needs to make certain it's reliable and that cannot easily be manipulated data, right? So that's of critical importance. Then predictive, naturally. We get through all that, we want to say, is it actually going to predict the outcome of 24 months past due. And then last but not least, orthogonality. So the concept of saying you could find a piece of data that's going to meet each one of these criterion, but is it really additive or supplemental to the data you already have? So what we find, for example, on a consumer who has a very thick credit file at the credit repositories, there's probably not a good reason to go out and find additional alternative data because it just doesn't tend to be additive in terms of that predictive value. If we move to the next slide, we think about this in a hierarchy and bring this forward because there's some data sets that FICO uses as part of our financial inclusion initiative that extends out of the United States. So we're very fortunate here to have a robust credit repository system that we can go to collect data, but we don't necessarily always have that when we're working in other countries. And so there's other means that you want to take a look at. But if we think about this hierarchy here, we say, level 0 is U.S. Credit Bureau data. Super robust data and it's very, very beneficial. Then we think about level 1 is any type of financial account data. So transaction level banking information, how are they managing their checking account, savings account information, credit line information, all very beneficial. Then we move on to the second level. We think about bill pay data. And so this tends not to reside in these repositories, but telco, cable, utility information, rent, all very predictive to the extent that we can get to that information. And then level 3 moves into understanding non-financial type of data. So public record data, property data. Can we understand how long someone has lived at a given address? And if there's no public record data saying they've been evicted, well, then likely they're paying as agreed. But it's a way you have to go to think about using alternative data in a way that you can help expand access to credit. We are working with other interesting types of data outside of the U.S., and I would just mention specifically SMS messaging, very important outside of the U.S. You can capture financial transactions in that methodology, as well as if we really have no information available to us, we're turning to partners using psychometric surveys in order to be able to support access to credit. So that's kind of the levels that we think about when we're referring to alternative data and how we build models at FICO.
Can you talk a little bit more about the psychometric survey? That's interesting.
Sure. Yeah, it's a very, very interesting approach. And so, part of that is about not only how you answer the question, but also how quickly you answer the questions so that it can't be easily manipulated. And one of my favorite examples of that is, through some scientists that have worked on this, they're saying it's very, very instructive to see how long it takes someone to answer the question, are you married or not? If it takes a long time, that's not a good sign, right? So, but there's all sorts of other interesting types of questions that you can ask through this process. And it is really about getting a foothold into access to credit if you don't have this other type of data. Because, ultimately, we think about financial inclusion is important. You need to be able to access credit in order to build wealth. And so, this is a stepping stone to help people in that direction.
That's great.
Yeah, thanks.
Rosemary or Mark, any thoughts on the definition?
I mean, I agree with what Joanne said in terms of like the basic definition is, many times the idea is looking outside of that traditional data to say, is there something else that can help it to be predictive in terms of losses down the road?
Right.
And I think you've covered it very nicely. I don't know.
Yeah, I think maybe the only thing that I would add would be the lender-specific data sets that some lenders have been able to accumulate, and you see this in payment processing space and industries like that, where they have access to their own proprietary data, and now they're becoming more able to use that data in conjunction with a lot of the data that you guys are pulling together to be able to underwrite more specifically to their client base, which is not a random sample of the United States. It's sometimes
No,
selected.
but that transaction data can be exceedingly predictive, absolutely. You're right, spot on.
Yep. I guess maybe one other thing is that we're talking really about data collection with respect to assessing credit, but I think that, sometimes there's data that's being collected for the purpose of looking at fraud.
Right.
And I think that is an important element in terms of what people are looking at to determine, is there, if you have a chain in terms of doing more fraud verification, what are the types of items that would make you, dig in a little bit deeper to be concerned about a fraud risk, especially when it comes to the marketplace lending space or online lending.
Yes.
Yeah, that's interesting. Very interesting.
Yeah.
Yeah, so I think, from your perspective then, Rosemary, what do the rating agencies think about this? I mean, how do you all think about alternative data?
Sure.
It's sort of interesting. I mean, Rosemary, Joanne talked about, the psychometric tests. I was reading something about how in the small business space you've got Fundera, right? So they look at things like the buzz about the business, the social media connections, the type of connections, and so on. But very curious, again, from a rating agency perspective, how you all think about this.
Sure. And, I would say that, it's interesting because when you talk about like the social media aspect of it, I think that's, kind of a funny thing when people say, are people coming to you and saying, we're underwriting based on social media? So far, that has not been the case. So I think that's a good thing.
Right.
It's a very good thing, yes.
Exactly.
Yeah.
What we're looking at is, for each, entity or, company that we're dealing with that's originating loans, how are they going about scoring the portfolio and, determining credit risk? And the question there is, many times FICO and the elements of FICO are a big, part of what they're doing, but they have their own models to assess credit risk because, they, may be more targeted, to Mark's point before about, that specific portfolio. And particularly if you look at like subprime lenders, being able to, determine creditworthiness is more challenging. So they're looking at additional elements in terms of that stability and willingness to pay. So I would say that, that's a conversation that we're having. I think the question in terms of the data is, can you actually use that data in terms of making sure that, you can use it with and, stay in the boundaries of the regulators to make sure that they're not stepping, outside the bounds of that. And the idea of the alternative data is really, again, to increase that predictive power of the scoring models. So I think, and I know you guys are going to talk about it a bit more later, but it seems like there's more willingness to look at alternative data because it is providing an increase in access to credit to folks that, perhaps the credit, invisible, or whether it's people that may be a thin file that, may not otherwise be able to get credit. And we've definitely seen that. But I think that, we look at it a number of different ways in terms of understanding how does that come into play in terms of the underwriting process. Normally it's an element of what they're looking at. And then, we definitely spend a lot of time talking about the regulatory elements to say, okay, what are you guys doing on a compliance front to make sure you can use this data and that the regulators are okay with it? So it has to be predictive, but then it has to also, remain within the lines. So a lot of it goes back to looking at the historical portfolio and how that may change over time. So many times people are trying to add, new elements in that they'll say, we can get some lift in terms of the predictive power. For us, the challenge is a lot of times we need to see the data to see the performance play out to make sure that it actually does, come to fruition as they expect. So, there tends to be, some, time frame associated with that as well.
But are you seeing, even with the more traditional lenders, are you seeing them change their models and their approaches where, historically they may have done some things one way, now they're sort of starting to bring that in?
Well, I think, I think in the beginning you said, things have changed dramatically,
Right.
but, things have changed dramatically even, with how people are looking at and determining, credit risk. And I think that, I think people are starting to, I think it's not like only a few people on the margin,
Okay.
Trying to look at that. I think that, many people are looking at alternative data because if everyone else is looking at it, then, they would like to have an understanding of, is there something that we're missing in terms of the predictive power? And then also the question is, as, certain things, may be removed from traditional credit scores, like I know recently liens and judgments were removed, so that may be important in terms of assessing credit worthiness for someone. So the question is, again, can they capture this data and then can they use it, and then is it predictive in terms of helping them to assess risk?
Can I ask a very simple question?
Yeah.
The non-financial data, how do you avoid redlining?
Well, I think that's the question, is that they have to basically determine that there's no, adverse impact, or that, they have to do samples basically to study that. So.
Maybe I could add to that. So, the way we think about it, we talked about all the criterion, right? That's incredibly important about the data source that you're going to use from a regulatory compliance, but also in thinking about it from an implementation standpoint. Where we're using alternative data is where you think about it as a second chance score, so that the consumer would have been declined had the alternative data not been available. And so in that case, what we're finding is that the regulators are satisfied with that approach. Where I think it starts to get muddier is if it's that thin file consumer that maybe could have gotten a score, and then you add alternative data, and it could go one way or the other, right? They could have, meet your criterion or not. And so that's a less clean space. And I think that it's open to a lot of conversation right now, right?
Yeah.
To the point, we would suggest that, where you went to school is probably a dangerous element to use. Mm-hmm.
I think people are also using trended data now, so I know that that's another discussion that people, have started to look at, is can we look at, someone that is, maybe a 640 FICO, they, if you start out at 740 and you're moving down, that's not necessarily want to lend to, but, if they're moving up the chain, then I think it's important to look at that as well. And I know that that's been an element that people are starting to look at as well, instead of point in time.
Yeah. Other questions from the audience? Okay, so I guess, Mark, from your perspective, right? Obviously, Macquarie is a large provider of capital to the fintech world, and one of the things that I've heard, and we've talked a little bit about it here, but in talking to groups like yours, is again, it's not so much the number of data elements, but it's sort of the predictive value of those data elements. So can you talk a little bit about Macquarie's view on all this?
Yeah, I think that over the last couple of years, we've seen a few different approaches to trying to incorporate alternative data into underwriting models, and I think people were facing a few challenges, and we're starting to see them come out of the other side of these challenges. One is they didn't really they had all this data, but they didn't have it tied together with performance data necessarily. So they're using all of these new underwriting metrics and characteristics, but to actually say that it has the X impact on default rates, they didn't have the data for that. Now they've been using it for a couple of years. They're starting to hit that 2-year mark, and those models are starting to improve significantly. I think what the benefit that all of this additional data that people can now collect, it also it's broken apart so that they can now use it to tailor to their specific clients, the specific people they're targeting. You have people like SoFi targeting prime borrowers, and you have other people like Inseeked where they're targeting where they're effectively lending point of sale and targeting Hispanic borrowers. The opportune would fall into that same category. And as you start building these data sets now, you can, and they're broken apart into many different attributes, you can start using them to underwrite to your specific clientele, and we're seeing a lot more of that. So when we're out there looking for people to work with, that's what we're trying to identify. That they have the ability to use all of this data, and like we've said, it's whether it's front end fraud, so using IP addresses, cell phone geolocation, knowing where they work, knowing where they live, making sure all of this stuff ties together to detect fraud at the point of origination, or whether they're using bank accounts and potentially there's other data, but primarily we've been seeing people use bank accounts and some of this kind of employment data, education data for underwriting. Seeing them be able to collect that data and then also and then use it in their own underwriting models. And then the last part that we've seen be very important, which kind of gets overlooked, is sourcing channel. Lenders now, if they have a differentiated sourcing channel, that sourcing channel provides a lot of information about the borrowers that you're attracting, and you can use that information to then tailor your underwriting models. So to kind of summarize that, it's ability to accumulate data and use it for fraud detection and underwriting, and then also to be able to tack on your own proprietary data to create a sustainable competitive advantage, because that's very difficult to do in this environment.
So it sounds like there really is sort of these two sides of it. There's the additional fraud-related data and then the additional credit-related data.
Yeah. And a lot of times they're the same, but I think when you start talking about social media data, that can be used for fraud, right?
Yeah.
It's totally fine, but you can't really use it for underwriting. And so that's where you start seeing Yelp scores in small business actually become real things, because if they have zero online presence,
Right.
but apparently they're doing millions of dollars in sales, that doesn't really make sense.
That's right. Yeah.
Right.
It truly would be indicative, I'm sure.
Yeah.
Yeah, exactly.
And you also get to see a lot of comments and things like that. And so we've seen small business lenders that are looking through the comments that businesses are getting and understanding whether this is a good business or a bad business. Are they getting a lot of negative comments? All right, that's something that we should take into account.
Yeah, it's like looking at the Better Business Bureau to some extent.
Yeah.
Right? So.
Yeah.
Yeah. Well, it's also interesting, kind of along the same lines we were talking about. The all data is credit data. I read a quote from a CEO of a company which happens to specialize in sort of the whole machine learning process for the underwriting process. And after he talks about how all data is credit data, he actually said that they even look at whether or not a borrower fills in his name or her name in capital letters in the application, and that actually has an impact on the credit score. So very, very interesting. I think the other thing that's interesting is when you look at it from the standpoint of, kind of their view on things, which is that, they say that it's obviously a great thing, and we talked a little bit about this earlier, where, the idea is you can get access to capital for borrowers with, very little credit history, potentially. So I guess I've got a question for the group, but one other thing I wanted to mention and sort of bring into the discussion is the whole regulation of the regulators themselves. So I know that the CFPB this past May actually issued an RFI on the whole use of alternative credit data, and the director Richard Cordray talked about how this alternative data. Again, could sort of help expand access to, I think it's 26 million Americans with no credit history, and then there's another 19 million or so, with very, very little. But then, of course, in the same breath, he talks about how, he talks about some of the risks, like, the quality of that data that they're collecting. He talks about how there'd really be a difficulty in correcting if there's errors. And then obviously the sort of the fair lending discrimination concerns. So I guess the question for the group is really twofold. One is, do you think this whole thing is ethical, and do you think the good outweighs the bad?
Yeah, I mean, from a FICO perspective, we think absolutely, done right, it is ethical and can help consumers as well as lenders and the overall economy. FICO obviously responded to the RFI that was, sent in for comment to explain our thinking on this, and also really suggesting, that guardrails, that are more clearly defined by the regulators would be incredibly helpful to the lenders that we work with. So, if we go back to the work that we did in developing our alternative data score, we worked behind the scenes for over 2 years doing research, as well as then meeting with every regulator out to known to man, it seemed to be, to make certain that they were comfortable with the approach that we were going to bring to market. Then we moved into a pilot mode with the 10 largest card issuers, so that we had a period of time where we could actually understand, is the score going to do what we think? So is it going to replicate that which we saw happen within our own internal walls when we were doing our research? Once you were comfortable with that, then we were able to go for broad release. So I guess my suggestion here is tread very carefully. You want to make certain that what you're doing is going to be regulatory compliant, and what we believe is, if you're building an empirically derived, demonstrably statistically sound score, you shouldn't run afoul of unfair lending practices. Yeah.
Right.
Yeah. Yeah. Oh, sorry. Go ahead.
I would say we also see a difference between that question is answered differently here versus abroad.
Yeah. Yes.
And here we've got a very robust regulatory framework. Well, maybe not. It's we have a lot of oversight here, whereas as you start to move abroad, you start looking at Asia or South America or Africa. That doesn't really exist, and so you see data used differently. You see a lot more personal data used. People pulling in, and I think that's where probably starts this ethical question starts becoming a lot more relevant, because you have people giving access to their cell phones, and cell phones these days have everything. So when you give a lender access to your cell phone in Thailand, that lender now has all your text messages, all your chats, your browsing history, your all the apps that you've installed, your where you are at any given point in time, and you can use that now for underwriting purposes there without really a whole lot of regulation or oversight.
Well, when you say so they will literally give the phone?
They when
the
they
records.
It downloads, they download an app and the app, and they give permission to that app to take all of the data off their phone, which includes all of that
Wow.
stuff. So we did look at a lender in Malaysia that was doing that.
Wow.
Yeah.
That's interesting.
I would agree. Yeah, I would agree with you. Outside of the U.S., rules of engagement very, very different. And when you start to think about it, if there's no other way to help this consumer provide access to credit, then you start looking harder and harder. And so that's why SMS messaging, as you've described, or other means, makes sense maybe outside of the infrastructure that we have here within the United States. And so, and I think the other trend that we're seeing is more towards, which you kind of hinted on, is consumer permission data. To the extent that can be verified, but the consumers are permissioning that data, could be very, very beneficial as well.
Yeah.
Right.
Yeah.
That's a good point.
In terms of the influence of these pieces of data, if I were going to do a regression on all these, I would hope that level 0, level 1 are weighted higher, level 2 is weighted a little less, level 3 is really marginal. I think the issues of ethics become when that no longer holds, and all of a sudden something from level 3 actually gives you a bigger signal.
Well, the question is whether you have 0, right? If you don't have
If we
level
don't have
0,
zero.
right? So then you're like, where are you going from there, right? In terms of the folks that don't have any traditional credit bureau score.
Exactly. So it's a prioritization. And so, yes, we would never, here in the U.S., see something on level 3 supplanting that which was on level 1 or level 0 with the credit bureaus. It's kind of thinking through, making certain that we have an appropriate hierarchy so that you're not going out and looking at, mobile device information here in the U.S. when we have, data that's, considerably more robust and FCRA compliant.
You would
Yeah.
have a separate model for level 3 data.
Oh, absolutely. Oh, yeah.
It's a little scary because, whether I fill out something in CAP really, the statistics on that just can't be that.
Right. I just want to say that that's not a FICO model.
Yeah.
Just need to get that out there, guys. So.
We haven't heard people using that either, so, in the deals that we've rated, so.
No, so.
Yeah, it's called XAML, Zest Automated Machine Learning,
Yeah.
interestingly.
Right. So I think, from a machine learning AI perspective, there is a place for that in this business to uncover, credit attributes that might be interesting or predictive. But when then we move to a credit risk model, something that's going to be used for credit underwriting, we move back to a traditional scorecard modeling approach because we believe in absolute transparency. The lenders rely on us to provide the reason codes that are understandable and palatable to consumers. And if in a true black box ML world, you can't accomplish that. Yeah.
Right.
Yeah, and I think recently the CFPB issued a no action letter to Upstart in terms of being able to use alternative credit data. So I think it's interesting that they've even gotten to that point in terms of, actually, I guess, blessing it to some extent.
Right.
So, I think it still remains to be seen because, again, as we've said, you have to make sure that you actually, stay within the bounds of the CFPB in terms of, but it may not be clear guidelines right now in terms of what can you and can't you use there.
True.
So.
Right.
That's important.
Right. Other questions for the panelists?
Yeah, I have a question. I think you mentioned the fact that you're validating the model on the alternative data on the data that you have in your traditional focus one. It's productive. But if we're talking about people trying to reach people who have no credit, so I can see there's some overlap. Right? You have a subset, and you train the model on that subset data, which have credit scores. Now we're trying to apply it outside of that. Is there, how do we know the ability on that non-credit subset of folks?
Right. So how are you confident that like an alternative data score will hold up over time?
It will hold up on that. It may hold up on, let's say, people who have credit, right, who already
Right.
have a FICO file.
Right.
And I think one of the things that we're talking about here is like think about people who are not served as people we want to use this on.
Right.
But those people, we have no validation of the model, right?
Right.
We can't, and there could be other factors that are more relevant in the model there.
Right.
How
So-
do we get around that?
Yes.
Oh,
Go ahead. Go
Yeah,
ahead. Go
I'm
first.
sorry to jump in. So I would say that, we've seen, lenders and opportune is someone that we've rated transactions for. And what they're trying to really look at is that first stability, right, in terms of how stable is this person and, and then, they're verifying, income. But then looking at their willingness to pay, and that's where you're looking at things like perhaps like that level 2, telco, utility data, rent, because there's a demonstrated, stability and potential willingness to pay. And if you don't have the sort of higher, the other data, then that has to be your starting point, right? In terms of not having a traditional FICO score for all of these folks. Now, the question, and, like Joanne working for FICO is, they haven't been pulled yet into the FICO infrastructure because they don't have the same level of data or maybe the same time frame. But then the question is, what is this lender doing in terms of like how much are they lending to this person to start off with? And so they may be lending smaller amounts as part of their business model to, give the person, a start, and then over time they can demonstrate through payment of that amount that, again, that ability, stability, and willingness to pay.
So, how far back does your alternative data set go?
The data set we're working with goes back to 2005.
Okay, so you would be able to look at people who took out their first trade line and then also see what this data looked like the few years prior, or just prior to that, and then. So I think that would be one way that you're isolating a population that takes out their first trade line, and you've got a couple years of data going into that. But it also comes back to specific lenders. When you're talking about thin file, no file borrowers, it's really specific to the lender, and you just have to see, right? And that's what Opportune's been doing it forever. So they've got 15 years of data now, using their underwriting metrics and directly to performance. And so these lenders just start out. They start out using some of this data, but they start small and they start short. So they get a lot of credit turns quickly without taking too much duration risk.
Just a general validation of the model, I can see that. Performance data, doesn't sound like that's available, so I'm thinking, how can somebody validate model outside of having the 15 years? But I mean,
We've seen.
It takes time.
Yeah, people.
It does take time, and so that was, to our point, why, if you have a traditionally non-scorable universe, you can either use reject inference to, do the validation of the model and make some assumptions, or you can actually do live testing. And we've had both happen with lenders that we work with. And to the commentary from my panelists, which is spot on, typically it's going to be a small dollar amount that's initially granted, and work to make certain that pay is agreed. So when our alternative data score is used, it's traditionally for a card issuer, it's initially a small line that's made available to them. And then the interesting thing for us is assuming they had no credit history previously, after 6 months they get a traditional FICO score, and then you can start to see them I call it that on-ramp to credit, and then they can start building their credit history. Right. And then maybe another lender might consider that lender might extend a little bit more credit to them, or they might become eligible for other credit product.
Exactly.
Yeah.
Right. Okay, go ahead.
Please, go ahead.
So as the alternative data sources grow, I'm a data scientist. Two things that I want to watch for, and they're not bad news, but one, you might have multiple data sources correlate with one another. People are very good here with machines are, or they would complete with one another. Do you see this? Do you worry about this, or do you see this as an opportunity?
Well, I guess do you want to start?
Well, it's certainly a problem. But it's one that people a lot smarter than myself are working on. We've seen a lot of lenders, put 1,000 variables into their data sets and didn't really get any lift out of it, because a lot of it's just kind of saying the same thing, and you could have built the same model with 15 variables, and we'll continue to see that, right? Because there's I guess I would maybe take a step back from that and say that there's two things when we're looking at using these large data sets. There's kind of a couple things that we look at. One is that you have 1,000 data points, and theoretically that should help you build a better model over time once you have enough performance data. But you need a lot of performance data in order to actually train on 1,000 attributes. We've seen people that build those models. They started with pure machine learning, and now they're kind of moving away from that to create models that are more explanatory, where they can see cause and effect a little bit better, while still using some machine learning technology. The other is we've seen where we've actually seen people, I think, create better sustainable advantages is where they're primarily using this data for verification, where they weren't able to verify things before. So it's not even adding a variable to your underwriting model. It's saying we're going to scrape all of your bank account data, and now you've reported your small business, you've reported your income, you've given us your tax returns. Can we verify your tax returns now with your income and expense data out of your business bank accounts? And now can we start breaking apart your and then you take it the next step and you start breaking apart the income statement, the tax return to find. So I think that those. So to your direct question, yes, people are moving, I think, away from pure machine learning, and then and using machine learning to clean data as well.
Any other questions from the audience? Okay, well, I'd like to thank our panelists. Great job. Thank you, everyone, for joining us.
Yes, thank you all.
Thanks.